Hi, hello. Thank you for joining us today. My name is Jim Denholm, founder and CEO of Ironbridge Private Wealth in Austin, Texas. And this is our strategic growth video series. Today, first day of March, spring is starting to be here. Last week, Major League Baseball started spring training, so we thought we'd make some baseball analogies. What we're going to talk about today is we're seeing economic indicators with a 100% success rate of predicting a recession. That's our perfect pitcher. Every batter this pitcher faces, he strikes out. Second, market indicators that have a 100% success rate of signaling that a bear market is over. This is our perfect batter. Every at bat, he gets a hit. So what we've got is this perfect pitcher versus a perfect batter. Something's got to give. We'll talk about a brief S&P 500 update and talk about two primary scenarios that we think could be happening. First, let's look bigger picture, list of bearish data and bullish data. One, the Fed continues to aggressively increase interest rates. Looks like we're going to still have another 2 or 3 interest rate increases. Inflation continues to be very persistent. Economic and housing data is weak and weakening even more. It's accelerating lower. We've got sort of this consistent threat of war that's been over everyone's heads for the last year. Last, we put a question mark because the debt ceiling could be an issue. In 2011, caused a 20% market decline when there was some couldn't get to a resolution and there was a U.S. debt downgrade. But it's politics, so maybe it doesn't matter. It doesn't mean anything. On the bullish side of things, corporate earnings continue to be pretty good. Balance sheets for a lot of corporations are okay and fairly strong. We've seen inflation start to ease some. We're continuing to see some easing of that pressure. Biggest bullish data point is the consumer continues to be resilient. Unemployment remains strong. The consumer is continuing to spend, and the consumer is 70% of U.S. GDP. If the consumer stays strong, bullish outcomes could happen. And lastly, we'll talk about this. There's been more stability within the markets. That's a good thing. So let's get started. First, let's look at perfect pitch number one. The yield curve is inverted. An inverted yield curve has a 100% success rate of predicting a recession. And it gets inverted when short-term yields are higher than long-term yields. Right now, a 6-month treasury pays 5%. A 10-year treasury pays 4%. That's an inversion. So historically, when this happens, again, there's a 100% success rate of predicting a recession. On average, historically, a recession starts within 12 to 18 months of the initial inversion. And the yield curve initially got inverted about a year ago. So that tells us that we've kind of got until the summer, July, August timeframe, that we should expect a recession to start. So this is a pretty big data point. Let's look at another one. This is another one we've talked about quite a bit over the last few months. Leading economic indicators. This is a compilation of 10 different economic indicators that are at the very forefront of economic activity. For example, if you're going to build something, whether it be a home or an office building or an industrial park or shopping center or whatever, the first thing that happens is you get a permit. Before you order materials, before you hire people, before you start construction, before you sell. Building permits are some of these leading economic indicators. Now, every time leading economic indicators go negative, that hasn't signaled a recession. But when it gets deep enough, when it drops by more than 4%, 100% of the time, a recession has followed. Historically speaking, a recession starts roughly 7 to 8 months after the leading economic indicators fall by more than 4%. They first got to -4 in December. So this is another indicator that says we should expect a recession to start by this summer, kind of July, June, July, August timeframe. So we've got two major data points that are kind of giving us that perfect picture. However, if we look at some data in the market, there are also some basically facing a batter that has that's batting 1,000. This is one of those. So the S&P 500, when we look at it relative to its 200-day moving average, it's the average price over the last 200 trading days. If the S&P falls by 20%, so it enters into a technical bear market, and then it emerges from it by being above its 200-day moving average, and it stays there for at least 18 days, there is a 100% of the time, first, markets do not undercut their lows. They've already made the lows, and they're higher 100% of the time on a 6-month, 12-month, and 18-month basis. This happened a couple weeks ago. So we've got at least one major data point that's saying we've probably seen the worst. It doesn't necessarily mean that we have to go into this major bull market, but it says that over the next 18 months, prices are going to be positive. Or over the next 6, 12, and 18 months, prices are going to be positive. Another one looks at demand versus supply of trading volumes within the S&P 500. This is a little more technical, but Ned Davis Research has a proprietary formula that uses trading exchange data to look at on a daily basis what's the volume of demand coming into the market and the volume of supply. It's a little bit different than the total volume traded because there are some trades that don't get executed if you put it on and don't get your price and you take it off. So what this looks at says, okay, well, they consider a bear market being supply outpacing demand for a certain period of time, and then it flips back higher. So we saw supply outpace demand most of last year. About a week ago, what happened, or a couple weeks ago, what happened is that we saw this flip. We saw demand flip up above the volume demand flip up above the volume supply. When that has happened, markets have been higher 100% of the time on a 3-month, 6-month, 12-month, 24-month basis. And markets never did undercut the lows. So we've had these macroeconomic data points that are really telling us we need to be concerned about recession, and that in a recession, average market decline is about 37%. We saw a 27% decline last year. So this is saying if we just see an average recession, we've got 20% downside. We would undercut the October lows. But then the market is starting to tell us, no, there's enough breadth underlying the market that we should expect higher prices. So let's just take a look at the S&P 500 real quick. This goes back through early last year. This is the all-time high in January of 22. We saw the bear market. If we look at these bottom two blue lines, this top that we've labeled resistance, this first data point over here on the left within this range, that was the Ukraine invasion. And what we've seen is that the market has been respecting this area outside of this kind of false breakout. The market has been respecting this area. It tested it many times right here. It spent some time last May. It provided resistance in May and June. There was this false breakout higher. It tested it again in September, tested it a few times in November and December, tested it again in January, February. And the market's been having a hard time getting above that. Now, on the flip side of it, the market's also been having a hard time getting down below this 3,600 to 3,700 range. This range, the top range is about 4,100 to 4,200. The bottom being 3,600 to 3,700 roughly. So if we ultimately take a look back, the market has done nothing for over a year. there's been a lot of movement higher, a lot of movement lower, a lot of choppiness, but ultimately hasn't really gone anywhere. So where we are right now, and if we look at some of these other things, we have this downtrend line, this gold dotted line. It broke above it earlier this year. That's a good sign. This 200-day moving average that we were talking about in the last slide is this gold solid line. It broke above it earlier this year, and it's testing it right now. On the flip side of it, we've got an uptrend line from the October lows and the December, January lows. It broke lower. So even within the market itself, we're seeing this kind of conflict of bullish signals and bearish signals, just like we're seeing that with some of these historical indicators. We're seeing 100% success rate predicting type of indicators that are giving us conflicting views. So it's a confusing market. What that bottom line tells us is we need to not be too optimistic, but we don't need to be too pessimistic at this point either. So let's look at a couple of the scenarios that we think may happen. First is a major bear market. The further we get into this year without something bad happening, the less likely this becomes. But if we're looking at this, it'd be a 30 to 50% decline in stocks from where we are today. We'd see a big drop in housing values. We'd see a deep recession. We'd see increased geopolitical risks. So we're starting to see some of those things already happen. We're just not seeing it reflected in the price. The opportunity in that environment is you have to be defensive. You have to have elevated cash holdings, and you need to put yourself in a position to take advantage of that environment. Now, on the flip side of it, like we say, we've started to see this kind of continued stability underneath the market, despite this increased warning signs from a macroeconomic standpoint. And the sideways, so the second scenario is that we enter into a kind of a choppy sideways market for multiple years. It would be like what happened over the last year, where things aren't great, but things aren't terrible. And we'd likely see a series of mild recessions. Interest rates would stay elevated. Inflation would stay relatively elevated. It would be a very frustrating market from a pure price standpoint. But to take advantage of that environment, you really want to focus on yield. In a major bear market, the Fed is going to cut rates to zero. In a sideways choppy market, they probably stay elevated. So we could see cash at 5 or 6%. We could see pipelines at 7, 8, 9%. We could see some real estate investments, both public and private, that could yield 8, 10, 12%. Private debt that could pay 9, 10, 12, 13%. And then you have to be a little tactical in the public markets. So it's an interesting environment. It's always dangerous to say this time is different. But with these indicators, these conflicting indicators, one of them is going to be wrong. Either the pitcher is going to strike out the batter or the batter is going to get a hit. And the perfect batter or the perfect pitcher is no longer going to be perfect. I think we need to give it through the summer, based on the historical timeline of some of these macro indicators, to have any real confidence that we've avoided the major bear market, or at least have that scenario become just a very minor probability scenario and not something that we really should be focused all that much on. So, it's a complex environment, and I think the bottom line, be a little bit more conservative than what you normally would be. Have some cash and take advantage of either environment. If you have questions, please do not hesitate to reach out to me. My direct email is jim.denholm you can follow me on Twitter at denholm_Jim. And then obviously online at our website, ironbridge360.com. Thank you for joining us again today, and invest wisely.